Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Semi-commercial mortgages. Semi-commercial mortgages are a type of property loan tailored for properties with both residential and commercial elements. They cater to businesses that require a blend of living and working spaces within one property. For instance, an owner-occupied building with a ground floor shop and an upstairs flat would be a prime candidate for a semi-commercial mortgage. Understanding semi-commercial mortgages. When looking to invest in a property that has both commercial and residential components, you'll likely require a semi-commercial mortgage. These mortgages are secured loans designed for properties serving dual purposes. Known as mixed-use properties, they usually consist of various commercial spaces, such as retail shops and offices, along with residential units like flats or apartments. Semi-commercial mortgages share similarities with regular commercial mortgages in terms of the lending process. This means you'll typically need to approach a commercial lender to secure the loan. While these loans may seem more complex than regular residential mortgages, understanding the basics can help you make informed decisions. Interest rates for semi-commercial mortgages can be either fixed or variable. Fixed interest rates allow you to lock in a set payment amount for the entire duration of the mortgage, while variable interest rates fluctuate based on market conditions. It's important to weigh the pros and cons of each option, keeping in mind your financial situation and risk tolerance. When applying for a semi-commercial mortgage, lenders will often request to see financial records and business plans relating to the commercial aspect of the property. They may also require a valuation of the property to ensure the loan amount aligns with the property's worth. Additionally, lenders will assess your credit history and affordability before determining the loan amount and terms. As a borrower, it's crucial to carefully evaluate the suitability of a semi-commercial mortgage in relation to your investment goals. Remember that the lender may repossess the property if you fail to meet your repayment obligations. Therefore, be sure to carefully consider the risks and rewards involved in the process. By understanding the basics and making informed decisions, you can better navigate the world of semi-commercial mortgages and invest successfully in mixed-use properties. Eligibility criteria. When applying for a semi-commercial mortgage, it's crucial to understand the criteria that lenders consider when assessing your application. The following paragraphs will provide you with a clear and concise understanding of the eligibility criteria, ensuring you have the necessary information to increase your chances of securing a semi-commercial mortgage. First and foremost, lenders will focus on the commercial aspect of your property. To determine your eligibility, they will evaluate several factors, such as your deposit amount. Typically, you'll need at least 35% of the property's value as a deposit or equity. However, this percentage may vary depending on the property, transaction type, and your personal circumstances. Another essential aspect when applying for a semi-commercial mortgage is your credit score. It plays a significant role in the lender's decision-making process. Ensure you have a healthy credit history to improve the likelihood of your application being approved. If your credit score isn't stellar, work on improving it before submitting the application. Affordability is another crucial factor assessed by lenders. They will evaluate your ability to cover the monthly mortgage payments, in addition to your current income and expenses. Be prepared to provide financial statements and proof of income during the application process. Bear in mind that some lenders may require a minimum annual income over and above the returns anticipated from the commercial aspect of the property or rental income. In conclusion, to improve your chances of securing a semi-commercial mortgage, focus on meeting the eligibility criteria such as deposit amount, credit score, and affordability. By doing so, you'll demonstrate to lenders that you're a reliable borrower with the means and intent to uphold your mortgage commitments. Application process. When you're ready to apply for a semi-commercial mortgage, the application process might seem challenging. By following a few steps, you'll find it easier to navigate. Here, we'll discuss the key steps so you can confidently move ahead with your application. First, research your options for a semi-commercial mortgage. These mortgages are specifically designed for properties with both residential and commercial elements. it is essential to find a lender or a broker experienced in this area to ensure smooth processing. A knowledgeable broker can help match you with the right lender, taking into account your needs and circumstances. Once you've chosen a lender or broker, it's time to fill out the application. Be prepared to provide detailed information about your income, expenses, and business plans. Additionally, the lender will require bank statements and possibly other financial documentation to assess your financial stability. It's important to be honest and thorough during this stage, as incomplete or inaccurate information can lead to delays or rejection of your application. Lenders will also require certain information about the property in question, such as its location, size, and current usage. They may ask for a property valuation to confirm its value and assess how much they are willing to lend. Be prepared to provide any necessary documents or arrange for third-party reports, such as an appraisal. In terms of presentation, ensure that your application is clear and easy to understand. Use bullet points to list key information and tables to organize data. Formatting your application this way can help the lender to assess your application more efficiently. When everything is in order, submit the application to the lender or broker. It's essential to stay in touch with them during this period, as they may need additional information or have questions about aspects of your application. Clear communication from the beginning can significantly improve the chances of a successful outcome. As you go through the application process, keep in mind that approval for a semi-commercial mortgage might initially take longer than a traditional mortgage, due to the unique nature of the property. Stay patient and remember, thorough research and a well-prepared application are key factors that will help you secure the right semi-commercial mortgage for your property. Types of semi-commercial mortgages. When considering a mortgage for a property with both commercial and residential elements, you will come across various types of semi-commercial mortgages. The main types include interest-only, part, and capital repayment mortgages. Each of these options has its own benefits and drawbacks, so it's essential to choose the one that best suits your needs. Interest-only mortgages allow you to pay only the interest on your loan for a specified period, usually between 2 and 5 years. This means that your monthly payments will be lower during the interest-only period, as you are not paying off any of the principal loan amount. This can be an attractive option if you're looking to maximize cash flow during the initial stages of your investment. However, you should be aware that at the end of the interest-only term, your payments will increase as you begin to repay the principal. Interest-only mortgages are quite common for semi-commercial properties. Part mortgages are a combination of interest-only and capital repayment mortgages. With this type of mortgage, you agree to pay a portion of the interest along with a portion of the principal each month. This allows you to reduce the principal gradually, while still benefiting from lower monthly payments compared to a full capital repayment mortgage. The balance between interest-only and capital repayment can be tailored to your specific financial situation and goals. Capital repayment mortgages require you to pay both the interest and the principal each month, with your payments gradually decreasing the principal over the term of the loan. This is the most straightforward mortgage type and can offer greater financial security, as you will be on track to fully repay the mortgage at the end of the term. However, it's worth noting that your initial monthly payments will be higher than they would be under an interest-only or part mortgage arrangement. In all cases, semi-commercial mortgages typically have a term of 3 to 35 years and can offer fixed-rate or tracker interest rates, usually based on the Bank of England base rate. The loan-to-value (LTV) ratio for these mortgages can be up to 75%. When deciding on the best option for you, consider your financial goals, risk tolerance, and the potential income generated by the property. Interest rates and charges. When considering a semi-commercial mortgage, it's essential to carefully examine the interest rates and charges associated with the loan. It's crucial to remember that the exact rate you receive will depend on various factors such as your credit history, the property's value, and the lender's specific criteria. In most cases, you can expect to receive loans of up to 75% of the property's purchase price or value. There may be options available for both owner-occupied and investment properties. Keep in mind that different lenders may require different rent cover calculations for investment properties, which could impact the available loan amount. Interest rates for semi-commercial mortgages tend to be higher than those for residential rental properties, yet lower than purely commercial mortgages source. This distinction typically arises due to the mixed-use nature of these properties. Besides the interest rate, you should also be aware of other charges that may be associated with your semi-commercial mortgage. Most lenders will require an arrangement fee, which may vary depending on the lender and loan size. It's crucial to consider these fees as you assess your overall mortgage costs. Additionally, it's worth noting that some lenders may offer interest-only mortgages for the full term of the loan. This option could be appealing if you're looking to minimize your monthly repayments, while potentially benefiting from capital growth of your property over time. In summary, when exploring semi-commercial mortgages, it's crucial to scrutinize interest rates, arrangement fees, and other charges closely to make an informed decision. Don't hesitate to seek professional advice if you need further clarification or guidance in navigating the mortgage market. Loan-to-value, LTV. When you're evaluating semi-commercial mortgage options, one of the most important factors to consider is the loan-to-value, LTV, ratio. LTV indicates the percentage of the property value that your lender is willing to finance through a mortgage. In other words, it's the proportion of the property's total value that you'll need to cover with your own funds. For instance, if a property is worth £200,000 and the LTV is set at 75%, the maximum loan amount you can secure would be £150,000. This means you'll need to contribute at least £50,000 as a deposit from your own funds. LTV ratios for semi-commercial mortgages can vary depending on several factors, such as the property type, location, and your financial circumstances. Typically, semi-commercial mortgages have a maximum LTV of 75%. Lenders set this limit to manage their risks while providing borrowers with a reasonable opportunity to invest in mixed-use properties. However, keep in mind that this percentage is not set in stone. It is possible to secure a higher LTV in certain situations, even up to 100% for mixed-use properties with special terms and conditions. Investing in a property with a lower LTV will most likely lead to a better interest rate, saving you money over the mortgage term. Furthermore, a smaller loan amount means that you'll have more equity in the property and could potentially have greater financial flexibility in the future. To summarize, it's essential to carefully assess the LTV requirements of your preferred semi-commercial mortgage lender when seeking funding for mixed-use properties. Understand that a higher LTV may also result in higher mortgage payments due to increased interest rates. Be sure to plan your finances accordingly to strike the right balance between risk and reward. Repayment options. When considering a semi-commercial mortgage, it is essential to understand the repayment options available to you. This will help you make informed decisions and choose a mortgage product that best suits your needs. One primary repayment option is the standard capital repayment method, wherein you pay off both the principal and interest on the loan each month. This ensures that at the end of the mortgage term, your balance is completely paid off. It provides a more reliable and structured repayment schedule, allowing you to plan your finances accordingly. Alternatively, you may opt for an interest-only mortgage, where you pay off only the interest on the loan each month. The primary advantage of this option is that your monthly payments will be lower compared to a capital repayment mortgage. However, it is crucial to note that you will still need to repay the loan's principal amount at the end of the mortgage term. Therefore, you must have a clear plan in place to pay off the outstanding balance, such as saving or investing throughout the mortgage term. When it comes to semi-commercial mortgages, fixed rates or tracker rates are common choices for the interest rate. Fixed rates provide the certainty of knowing your monthly payments will remain the same for a set period, usually 2 or 5 years. Meanwhile, tracker rates are variable and generally linked to the Bank of England's base rate, meaning your monthly payments may rise or fall in line with changes in the base rate. It is worth mentioning that early repayment charges may apply for some semi-commercial mortgages. These charges are fees you may incur for repaying your mortgage early, either in full or a significant portion. Before committing to a mortgage product, make sure to discuss these charges with your lender and understand when they may apply. In conclusion, understanding the repayment options, interest rates, and potential early repayment charges for your semi-commercial mortgage is essential. This will enable you to make informed decisions and choose the most suitable mortgage product for your unique circumstances. Semi-commercial property types. When considering a semi-commercial mortgage, it's important to understand the different types of semi-commercial properties available. These properties are a blend of both residential and commercial elements, making them a unique investment opportunity. Here, we'll discuss some common semi-commercial property types and the factors that might influence your decision to invest. One prevalent type of semi-commercial property is a commercial unit with flats above or below it. This could be a retail shop or office space on the ground floor, with residential flats or apartments occupying the upper floors. The commercial portion of the property often generates rental income, while the residential units provide additional income or accommodate the property owner. These properties present a balanced mix of commercial and residential investments and can be an attractive prospect for investors. Guest houses, bed and breakfasts, and small hotels are also common semi-commercial properties. These establishments usually have owner-occupied living quarters and offer guest accommodations for paying visitors. This dual nature of the property allows the owner to live in the residential space while generating income through the commercial aspect, blending the balance between home and business. Now, let's consider the equity in these properties. Equity refers to the value of the property after deducting any outstanding mortgage or loans secured against it. Essentially, it's the portion of the property you own outright. For semi-commercial properties, the combination of commercial and residential elements can affect the way lenders assess and calculate your equity, often leading to different borrowing options and commercial mortgage rates compared to purely residential properties. Finally, you should keep in mind that each semi-commercial property type may face different risks and rewards. Factors such as property location, market demand, and the success of the commercial entity can all play a role in determining the long-term success of your investment. Before committing to a property, it's essential to conduct thorough research and ensure you understand the unique elements that a semi-commercial property can bring to your investment portfolio. Benefits and risks. Investing in semi-commercial properties can offer you several advantages. One of the primary benefits is diversification. By owning a property generating both residential and commercial income, you can enjoy a diversified income stream, potentially increasing stability and reducing risks in your investment portfolio. 1. When it comes to borrowing, a semi-commercial mortgage involves a tailored approach. As a result, only certain lenders are capable of arranging such loans too. While this can be limiting, it also means that you have the opportunity to find bespoke arrangements suited to your specific needs and circumstances. However, there are also potential risks associated with semi-commercial mortgages. Firstly, you may encounter higher interest rates. These are generally due to the perceived higher risk associated with commercial properties. 3. Commercial mortgage rates are determined on a case-by-case basis and tailored to the individual or business applying for the mortgage. 4. Therefore, it's crucial to shop around and negotiate for the best possible deal. Another consideration is the loan-to-value (LTV) ratio that lenders are willing to offer. In general, you can expect up to 75% LTV for semi-commercial mortgages. 5. Whilst this may still be a considerable amount of financing, it also means that you will need to produce a larger deposit for the property compared to what you might need for a residential mortgage. In conclusion, semi-commercial mortgages can offer opportunities for investment and borrowing in the commercial property sector. However, it's essential to be aware of the potential risks involved and carefully consider your options for financing these properties. Final thoughts. In the world of property financing, semi-commercial mortgages serve as a valuable option for those looking to acquire or refinance properties with both commercial and residential components. By understanding the ins and outs of this specialized mortgage type, you can make informed decisions to ensure your investment pays off. Before diving into semi-commercial mortgages, it's essential to understand the differences between these and their counterparts, commercial and residential mortgages. Remember that commercial mortgages cater to properties used solely for business purposes, whereas residential mortgages are designed for properties exclusively occupied by residents. Semi-commercial mortgages find their niche by addressing the financing needs of mixed-use properties, blending both commercial and residential elements. Partnering with the right lender is critical for success in securing a semi-commercial mortgage. Various lenders offer these specialized loans, with each having its eligibility criteria and deposit requirements. It is crucial for you to research different lenders and understand their terms and conditions to find the best suited option for your investment. A semi-commercial mortgage may require a higher deposit than a traditional residential mortgage due to the mixed-use nature of the property, but interest rates may be similar. Like any financial decision, it's essential to compare the rates and terms of different mortgages to ensure you're getting the best deal possible. In summary, semi-commercial mortgages provide a specific solution for financing properties that combine commercial and residential elements. Knowing the differences between commercial, residential, and semi-commercial mortgages will guide you towards the most suitable financing option. Finally, partnering with the right lender and comparing interest rates will ensure that you secure the most favorable terms for your investment. So, arm yourself with knowledge, and you'll be well on your way to successfully navigating the world of semi-commercial mortgages. What factors influence semi-commercial mortgage rates? Several factors can influence semi-commercial mortgage rates, including your credit history, the property's location, and the loan-to-value (LTV) ratio. Lenders will also assess the type and viability of the business being run at the property. Generally, the stronger your financial and business profile, the more attractive the mortgage rates you could secure. How do lenders assess eligibility for semi-commercial mortgages? Lenders assess eligibility for semi-commercial mortgages based on various factors such as your credit history, the property's value, and your ability to meet repayments. Additionally, they'll evaluate the business plan and financial performance of the commercial aspect of the property. You may be required to provide details of your income, proof of trading history, and other relevant documentation to help them assess your eligibility. Are there specific requirements for mixed-use property mortgages? Yes, mixed-use or semi-commercial properties have specific requirements for obtaining a mortgage. These properties combine residential and commercial elements, such as a flat above a shop or a restaurant with living accommodation. Lenders will take into account factors like the proportion of residential versus commercial space, the type of commercial element, and the property's overall value. What is the maximum loan-to-value ratio for semi-commercial mortgages? The maximum loan-to-value (LTV) ratio for semi-commercial mortgages varies depending on the lender and specific circumstances. Typically, the LTV ranges from 65% to 75%, however, higher LTVs may be possible in some cases with certain property types or borrowers who have a strong financial profile. Do semi-commercial mortgages have different repayment options? Semi-commercial mortgages can offer various repayment options. You might choose between interest-only or repayment, capital and interest, mortgages. Interest-only mortgages allow you to pay only the interest charges on the loan each month, with the full amount repaid at the end of the mortgage term. Meanwhile, repayment mortgages require you to pay both the interest and a portion of the principal each month, gradually reducing the outstanding balance over the mortgage term. Can I refinance my existing property with a semi-commercial mortgage? Yes, you can refinance your existing property with a semi-commercial mortgage, particularly if your property contains both residential and commercial aspects. Refinancing might help you secure better interest rates or more favorable terms if your financial circumstances, or the property's value have improved. It's essential to consider the costs associated with refinancing, such as any early repayment charges, valuation fees, and legal fees, before making a decision. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.